This BlackRock copycat just unveiled a report that is saying that we are going to have a recession. In fact, he's saying there's a 90% chance of this happening. We're going to dive into all of this groundbreaking report, what it means, and what other CEOs are saying as well. Do people necessarily agree with this BlackRock copycat? First, let's dive in to the report that was published by Apollo Management, quote, saying that there's empty shelves, trucking layoffs, and that's going to lead to a summer recession, and Apollo's shocking trade fight timeline. So the economic impact of tariffs imposed by Trump administration will soon become apparent everyday Americans and lead to a recession this summer. Well, let me check my watch here. It seems like summer is just a month away here, folks. So Apollo is saying that all of this is going to happen. It's going to happen very, very quickly. Empty shelves are coming soon. And so is a, quote, voluntary recession, right? He's like, this is what Trump is doing on purpose. This is voluntary. Major retailers will soon file for bankruptcy as a recession takes hold, an economist Torsten Slok said. That is the guy who wrote the report. So I am sorry for butchering his name, but he's a chief economist at Apollo Global Management. And so earlier this month, they've calculated the probability of what he calls a voluntary trade reset at a shocking 90%. So let's dive in to a little bit of this report and see, just how likely it is, because he says it's a probability of 90%. So the U.S. economy has been the envy of the world for decades. So at least he recognizes that we are the top dog, and everybody's been barking at our ankles, trying to nip at us here for a while. But the tariffs have implemented in a way that has not been effective. And there is now a 90% chance of what can be called a voluntary trade reset recession. So the VTRR. So see the first chart below. So this is what they're talking about here. This voluntary trade reset recession, right? So we're implementing higher tariffs, Doge laying off government workers, which is leading to negative wealth effects and lower corporate and consumer confidence. And then also we're starting with, a lot of these tariffs, which are being taken kind of hostile, which is leading to lower tourism. There's some retaliation and some uncertainty about this because of just how sporadic Donnie T has been in these tariffs. But let's get back to the point here. Implementing extremely high tariffs overnight hurts many businesses, particularly the small business, because the tariff must be paid by the business when the imported goods arrive. So with that, they expect ships to sit offshore, orders to be canceled, and well-run generated retailers to file for bankruptcy. The challenge for small and medium-sized enterprises are now a macro problem for the U.S. economy, where small businesses account for 80% of U.S. employment and CapEx. But the one thing that they're talking about here is that it's going to drastically hurt the small businesses, but it hasn't affected the job growth just yet, right? We're there, but we're not 100% there just yet, where everything is crashing and burning. But it is affecting things, right? We're seeing the overall CapEx of the U.S. economy, and I'll make this bigger for you guys, start to increase at a similar rate to what we see the S&P 500 in capital ventures. So that is not a good sign. We don't want to necessarily see these growing at a similar rate. We want to see the top one growing faster than the other. We want to see businesses growing faster than the underlying investment. And one way to quantify the coming negative impact on GDP is to compare the current tariff increases with the tariff increases observed in the trade war of 2018. Another trade war under Donnie T. But this one didn't get quite the notice that This last one didn't get quite the notice that we got right here, right? So what can be done to avoid this recession? Everybody's saying, okay, of course, we've got to get an agreement with labor and capital and natural resources with our close neighbors. The 10% tariff can stay in place, giving 180 days to negotiate non-tariff barriers. If agreed, for China, one approach could be keep the tariffs in place on autos, solar, and other strategic partner groups for all of their products can gradually phase in over 18 to 24 months. So it's interesting, right? Let's look at this. Total employment of firms with less than 500 workers is 110 million jobs, right? So a lot of small businesses here run the overall economy. And so it's good to nurture those small businesses and, in a sense, make sure that those small businesses are still continuing to be able to prosper, right? So there is some issue here with all of this, but, you know, these recessions, it's not going to be a hot boy summer, according to Torskin Slock. All right. I, for one, I'm flip-flopping on this one. I don't know where we're exactly going to be. I think that there's going to be a recession, not a 90% chance. I think if they start to see a 90% chance of a recession, they're going to start to pull back, right? I don't think that they're necessarily going to continue to rise forward and make a bunch of drastic policies, especially when we have people like Ray Dalio and all these other CEOs coming out and sounding the alarm bells, right? The biggest issue with a recession, or the biggest start of a recession, is when everybody gets very worried of what could potentially happen, right? So that's when consumer confidence is low. We're seeing it very, very low right now. Consumer confidence at its lowest it's seen since COVID. And then now we have billionaires coming out, influential people coming out and saying that there could be a recession and could be really quick. Multiple CEOs have come and challenged Trump tariffs amid a recession fears because business is not going as usual. Business is not booming like we originally thought, folks. So as we can keep business booming, we've got to continue to keep these tariffs, I guess, at top of mind, right? I mean, like they're trying to fight inflation. The Fed is stuck in between a rock and a hard place at this point, right? Because we got 60% of CEOs saying that they expect a recession within the next 6 months, right? So what could happen? What could the Fed do to avoid that, right? They would need to lower interest rates, or Trump would need to get off the tariff. Somebody would need to crack first. But look, I love to show you guys this. I show you it every single time. Last time we were sitting at 5%. Now we're at 6.7. We're launching up. I almost started to say we're skyrocketing it up. I know you guys love that. But we're seeing 6.7% now of looking like we're going to cut. So more than likely in a few days here, we're not going to cut in next week. We're not going to do it. I mean, just by looking at it. But we're seeing the Dixie start to react positively. Finally, back over that 100 mark. Finally, we are back. We're seeing some strength in the US dollar, at least compared to other fiat currencies. We'll go over to how the market's reacting here in a minute. Let me check over to the chat because a lot of you guys came over from the other channel, so I appreciate that. Got McLovin saying, we've been in a slow death spiral for at least the last 2 years. Make a course correction or crash and burn. And I agree. And I think that's why these tariffs are coming with a lot of controversy, because essentially what we're seeing is, the Dixie go from the worst start in history, year to date, down 8% almost, right? I mean, even with what we're seeing today, the Dixie is not doing well. All time, it's down 16%. All time. That's crazy, right? And that's because we just haven't seen the strength and the push that we needed to see with all of this. But we need to keep these tariffs in line because of this, right? We've got all-nighter hider, the GOAT, saying he's starting his truck, but please remember to smoke this like Cheech and Chong. And hit the subscribe button with the bell notification so you guys know that I am going live and you could join the chat. But let's keep diving on in to these articles and how they're describing these empty shelves, right? The Trump administration has paused some of these tariffs, but hiked duties even higher on China. And I think that's interesting as well, right? That we're seeing Trump really go after China pretty hard. And I think, to be honest, it is somewhat necessary. We need to see that. China is not the only source of consumer goods, but it does have a large role in the U.S. economy. U.S. imported $438 billion of goods, almost $439 billion in 2024. And according to the Office of the United States, it's putting it right behind Mexico and above Canada on its list of trade partners. And Mexico and Canada are right next door, right? China's not exactly close to get to. So these are some evidence of a pull forward in orders formed before long road tariffs were announced, which would keep goods on the shelves longer than an Apollo timeline sets out. Don't expect empty shelves just yet. Stock is still up and demand is slowing. So although they're sounding the alarm bells here saying everybody go buy everything because the stocks are going to be empty over the summer, CNBC is saying, hey, just pump the brakes a little bit, right? We're not there quite yet. We could cut interest rates. Look, it's a small percent chance, but it's 6.7% chance we could do that, right? The S&P 500 is reacting just about even. It's at 0.6%. Look, everybody looking at the S&P 500, they're looking at it compared to Nvidia, Bitcoin, all these different things. A 0.6% move in a day for the S&P 500 is a very solid day, right? We're not looking to make huge returns on a single day like we have, right? McLovin said the Fed is like a slow reacting, panicky plane pilot, jerking the yoke and cranking the throttle back and forth. And I think a big issue with the Fed and just in general is that they look at backwards looking data, right? So what is CPI that's going to come out on like the 12th or 13th? It's going to be looking at April, right? So we're already going to get data that is 2 to 3 weeks behind. The Fed is going to have to wait another month, to react to that data unless they conduct an emergency cut. And then we're already basically 2 months behind when they decided to cut. So you have to be a little bit more forward thinking than the Fed. And the reality is that the data collection services in the United States are just absolutely atrocious. Job data is terrible. A lot of things are still sent out by surveys. Like, who the hell is taking a government survey right now, filling it all out, and then licking a stamp and mailing it back out? That just, quite frankly, doesn't happen anymore, right? Hell, 90% of people barely answer emails. So I don't think that we're going to start to see these surveys start to catch up and allow the Fed to make more timely decisions, just strictly because we don't have the capability to do that right now. And I think that's the biggest underlying issue with all of this, is that we have so much underlying issues underneath the hood. It's just about government efficiency. And to be honest, right now, our government is not efficient at all. So I'm going to keep diving into more of these topics later on. So as All Nighter Hider says, smoke that like Cheech and Chong. Hit the subscribe button with the bell notifications because I'm going live at least 5 days a week. So come and join me. Tell a friend to join the Macro Insights. And I will see you guys all tomorrow.